Welcome back to AlgoBot, the channel where we break down automated trading strategies one line of code at a time. I'm your host, and today we're exploring an expert advisor for MetaTrader 5 called the Directional Persistence Regime Switch. This is an original, first-principles system that doesn't lean on any classic chart indicator. Instead, it studies the raw direction of each bar and asks a simple question. Is the market currently trending, or is it snapping back? By the end of this walkthrough, you'll understand how it measures that, how it decides to trade with or against the move, and how it manages risk. Let's dive in. So what exactly does the Directional Persistence Regime Switch do? At its heart, this strategy reduces the entire price chart down to a single stream of decisions. For every completed bar it asks, did price close higher or lower than the bar before it? That gives a sequence of +1s and -1s, the pure sign of each move. The core idea is that markets go through different moods, or regimes. Sometimes an up move tends to be followed by another up move. That's directional persistence, a trending regime. Other times an up move tends to be answered by a pullback. That's anti-persistence, a mean-reverting regime. No single fixed rule survives both. A pure trend follower gets chopped up in a ranging market, and a pure fader gets run over in a strong trend. So instead of guessing, this expert advisor measures which behavior is currently active and lets that measurement choose the mode. It does this by computing something called the lag-1 sign-autocorrelation over a look-back window of the last 40 returns. Don't worry about the name. We'll unpack it shortly. The result is a single number between -1 and +1 that acts as a regime coordinate. Volatility is measured with a standard 14-period average true range, which scales every stop and target and also filters out small, indecisive bars. This approach trades a single symbol on a single time frame, taking one position at a time. It's well suited to traders who are curious about adaptive, rules-based systems and who want to understand how a strategy can switch between trend following and mean reversion automatically. As always, this is educational information only, not financial advice, and trading always carries the risk of loss. Let's look at the mechanics. Let's walk through the logic step by step, exactly as the code runs it. The expert advisor only acts once per newly closed bar, so it works on confirmed data rather than a flickering live price. First, it needs enough history, at least the look-back window of returns plus the average true range period. Once it has that, and provided there's no open position already tied to its magic number, it begins the calculation. Step 1 is the regime measurement. The strategy looks back over the last 40 bar-to-bar returns and records only the sign of each one, up, down, or flat. It then checks how often one sign is followed by the same sign versus the opposite sign. Mathematically, it multiplies each sign by the one before it and averages those products. The result, called rho, lands between -1 and +1. A value near +1 means moves strongly persist. A value near -1 means moves strongly reverse. A value near 0 means there's no reliable memory at all. Step 2 is the regime decision, governed by a threshold set to 0.20. If rho is at or above +0.20, the market is in a persistence regime, and the strategy prepares to trade with the latest bar's direction. If rho is at or below -0.20, it's in an anti-persistence regime, and the strategy prepares to trade against the latest bar. If rho sits between those two thresholds, the market is judged memoryless. There's no structure to exploit, and the expert advisor simply stands aside. Step 3 is the noise filter. Even in a valid regime, the strategy only acts if the most recent bar actually moved with conviction. It requires that bar's range to be at least half of the current average true range. A tiny, hesitant bar is ignored. Once all conditions align, the strategy enters. In a persistence regime, it buys after an up bar or sells after a down bar. In an anti-persistence regime, it does the opposite, selling after an up bar or buying after a down bar. Risk management is fully volatility-based. The stop loss is placed 1.5 times the average true range away from entry. The take profit adapts to the regime, a wider 3 times multiple when riding a trend, because persistence tends to extend, and a tighter 1.5 times multiple when fading, because snapbacks are quick. Then it waits for the next bar. Let's look at the actual MQL5 code you'd see in MetaTrader. At the top are the input parameters, the dials you can adjust. Lookback, set to 40, is the window of returns used to gauge the regime. Regime threshold, at 0.20, is how decisive that directional memory must be before the strategy acts. Trigger ATR fraction, at 0.50, is the minimum size the latest bar must have, measured against the average true range. Then we have the ATR period of 14, a stop multiple of 1.5, and the 2 reward multiples, 3 for trend trades and 1.5 for reversion trades. Below the inputs is the regime switch itself. The code sets a trend flag when rho is greater than or equal to the threshold, and a reversion flag when rho is less than or equal to the negative threshold. If neither is true, the function simply returns and no trade is placed. Next comes the direction choice. In the trend branch, is long is set true when the latest bar sign is positive, so the strategy rides the push and it uses the trend reward. In the reversion branch, is long is set true when the latest sign is negative, so it fades the push, using the tighter reward. Now look at the 2 order blocks. On the buy side, price is taken from the ask, the stop loss is placed a stop distance below, the take profit a reward multiple of ATR above, and trade.buy is called. On the sell side, it mirrors exactly. Price from the bid, stop loss above, take profit below, and trade.sell is called. Both sides share the same volatility scaled structure. Now let's bring this to life on the chart. In the lower panel, you can see the strategy's own regime coordinate, the lag 1 sign autocorrelation we called rho. It swings between -1 and +1. The upper dashed line marks the persistence threshold at positive 0.20, and the lower dashed line marks the anti-persistence threshold at negative 0.20. The band between them is the stand-aside zone, where the market is judged to have no reliable directional memory. Look at the left side of the chart. Price is stepping steadily higher, one green bar after another, and notice what rho is doing underneath. It's sitting well above the upper threshold, up around positive 0.5. That tells the strategy the recent up moves have been persisting, one push followed by another. This is a trending regime. Now watch the bar marked with the buy entry. This is a decisive up bar, and crucially its range clears the noise filter, meaning it moved more than half of the average true range. With rho above the persistence threshold and a strong up bar just closed, the strategy signals along. It buys in the direction of the push, placing its stop 1.5 ATR below the entry and its take profit a full 3 ATR above, because in a trending regime, it wants to give the move room to extend. Follow the next few candles. Price keeps climbing, bar after bar, exactly the persistence the regime coordinate was describing. The move carries all the way up to the take profit target, and the long position closes for a completed trade. Notice how the wider 3-to-1 reward setting let the trade ride the trend rather than exiting early. Now the character of the market changes. After that push, price stalls and begins to roll over. Watch the regime coordinate in the lower panel. It falls out of the persistence zone, drifts down through the neutral stand-aside band, and crosses below the lower threshold into negative territory. The market has flipped into an anti-persistence regime, where up moves tend to be answered by pullbacks rather than followed by more buying. Here's the key contrast. See the bar marked with the sell entry. It's an up bar, a push higher, and in the earlier trending regime the strategy would have bought it. But now rho is below negative 0.20, so the interpretation is completely reversed. The strategy reads that up push as something likely to be faded, so it sells against it. This is the regime switch in action. The same kind of up bar produces opposite decisions depending on what the market's memory is doing. For this fade, the stop loss again sits 1.5 ATR away, but the take profit is tighter, just 1.5 ATR, because reversion snapbacks tend to be fast and shallow rather than sustained. Watch the candles that follow. Price rolls back over, the pullback plays out, and price reaches the take profit target below, closing the short for a completed trade. Step back and look at the whole sequence. The very same tool, that single regime coordinate, produced a with trend buy on the left and an against trend sell on the right, and it adjusted its profit target for each context, wider for the trend and tighter for the fade. That's the entire philosophy of the directional persistence regime switch. Rather than betting that the market is always trending or always reverting, it measures which behavior is active bar by bar and adapts. Of course, No regime reading is perfect, and there will be times the market shifts right after a position opens, which is exactly why every trade carries a predefined, volatility-based stop. This is illustrative and educational only, showing how the logic is designed to behave. That brings us to the end of our breakdown of the directional persistence regime switch. Today we saw how this expert advisor reduces price to its stream of directional signs, measures whether that memory is persisting or reversing using the lag 1 sign autocorrelation, and then switches between trading with the move and fading it, all while scaling its stops and targets to volatility. It's a genuinely adaptive way of thinking about the market. Remember, everything in this video is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. Trading involves real risk, and losses do occur. If you found this useful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe for more MT5 strategy breakdowns. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.